if there was ever going to be a currency to challenge the US dollar, I believe it would be something from the BRIC zone. But if you look at recent trends with how they treat each other, they don't even want each other to be successful.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 439. My guest today has two foundational beliefs: that Wall Street is broken and real estate is the cure, and economics tells the future. Nic DeAngelo asset manages a $206 million portfolio, and he fuses economic foresight and real estate knowledge to drive his strategy of acquiring institutional-grade real estate assets across 20 states. Today, Nic is going to share his perspective on the upcoming inflation decade, the U.S. dollar's future, and AI's transformative investing power. Nic, welcome to the show.
Great to be here. I really enjoy your show and your audience, and I'm excited to dive in today.
Tell us a little bit about yourself and how you got started investing in real estate.
I actually started in construction, of all places, but I started at a very young age. And really, I realized very quickly I didn't want to do that. And so I surveyed the landscape of who were the most successful people that I saw that had good lives, that could spend time with their families and really building serious net worth. And I saw that they were real estate investors. So I did whatever I could to be close to these individuals. A lot of them were friends and even some family. And I worked for them almost for free, for bare minimum, tried to add as much value as possible. So that was, my mid-late teens even. And then by the time I graduated college, I went all in. It was the wake of the financial crisis. So you can imagine how many investment groups were hiring at that time, Brian, right? The number was zero, right? Basically, for the ones I talked to, there were two family offices that were very small, multi-generational and sophisticated, but very small. And I basically bartered my way in. I basically bought my way into a job with a marketing list saying, here's the name of 500 people that although no one's buying real estate, you can contact these people that I've put together and I've reached out to and compiled, and they do want to buy apartments at significant discounts. So I was able to bring in revenue day one with these organizations, and both groups that I was able to work for taught me the ropes for free. I worked for free, but I learned from multi-generational real estate investors that have been amazing friends, mentors, and partners over the years. So my background's classically trained. I worked for free to get that education, and I'm blessed to stand on the shoulders of really, really great individuals that took the time to teach me.
You started during the Great Recession, and of course, the economy, that was an important part. Talk about the factors, the external factors that have affected you as you built and grew your real estate portfolio.
I mentioned I was classically trained by amazing groups. I leaned into acquisitions, which was a bad word at that time, because these individuals had the money and had a more or less it wasn't, I wouldn't say a stable portfolio, but more stable than anyone else in the market that I knew. So I leaned into acquisitions. I was buying distressed assets, many weeks up to $10 million. I had cashier's checks in my jacket pocket, buying at the courthouse steps. And I was a young man in my very early 20s. So the fact that someone would hand me $10 million of cashier's checks still blows my mind to this day, Brian. But I built out with these individuals, with these groups, their acquisition arms at a very aggressive high level. Then eventually we had too many assets. So I stepped into asset management. I founded Saint Investment Group at that time, and as an asset manager, kind of as a third party to partner with some of these, really great groups. And then we reached a point where we were expanding rapidly. We had asset management, we had acquisitions down. We started working with outside investors in 2015. And we found that we were working with a much older demographic. So we were working with mostly baby boomers, very successful business owners, or business sellers, people who had sold their business and had a lump sum of cash. So we leaned into fixed income assets. So we started all the way from ultra distressed, ridiculously high return assets. And we've, through our progression have landed on fixed income assets as really our specialty, because we've kind of worked with the same baby boomer generation as our core, ultra high net worth baby boomers. And that's what they had wanted at this stage of their lives and their career. So with the backdrop of the US economy as it is today, lots of highs, lots of lows, we get good news and bad news, and sometimes a slap and a punch and a kiss at the end, right? With all that conflicting information, we found from our investor base, they really wanted fixed, stable, smooth sailing. So that's how we've chopped up the market on our side and found the best niche for our demographic on our side in the midst of the different stages of the economy.
And when you say fixed income assets and fixed and stable, what are you talking about?
Mortgages, primarily residential single family mortgages. Just to double drill down, we found, we really did an analysis. The other half of our portfolio is industrial, which is you're making 5, 10, 20-year bets. You're looking at things like very high level economics when you're investing into the industrial sector. So we said, look, that's not at the right time frame right now. Industrial is a lot to sort through on its side. So what else that's a little more stable, that has a little more stable expectations of income could we find in the real estate sector? Again, I'm a real estate dog for life, Brian. I'm a lifer in real estate. And what we found from our analysis was that US-based mortgages, let me repeat that. United States mortgages in the single family sector were the most rock solid 20 plus year time horizon investment that we found on our side. So we really leaned into that and purchased over 500 mortgages. I was familiar with them early on in my distressed asset purchasing days when we were buying a lot of properties at the courthouse steps. They're attached to notes. So someone's doing that foreclosure. It's not always banks. A lot of times it's private owners. So at Saint, what we did was purchase mortgages privately as the owner. We own over 500 of them and collect a fixed return to split with our investors.
I want to get into some of the economic trends that we talked about. And in the intro, I mentioned that you have a perspective on the upcoming inflation decade. Why don't we start there? What do you mean by that?
I'm a contrarian by nature. I'll preface everything I say that I'm very often not among a big crowd with opinions on economics. Sometimes that's amazing. Other times people don't appreciate that. I will say that. But what I will say as far as it relates to inflation specifically, the biggest names are looking at 10 plus years of inflation ahead. And I don't mean high numbers like mid 2022 where we saw 9.1 or 9.2. I'm talking that inflation is sticky where we have to do something on a governmental interference level, like the Federal Reserve keeping rates high, for instance, to combat inflation that's not nailed down like it was for so many years, 15 years or so, that we have these record low rates. So what I mean by that is I believe that the downstream effect is that mortgage rates are going to end up very high for 10 plus years. We're already, and I've been saying this for about 18 months, and we're already seeing this early in 2024, we're seeing that their new headlines are not that the Fed's going to drop rates 6 times like was the early bet towards the end of last year. It's now, there's discussion saying they might not drop rates at all in 2024, which goes against their own dot plot. For those that don't know, the Federal Reserve tries to maintain a lot of transparency. They have something called the dot plot, which each of the board members of the Federal Reserve, they put a dot on a map of a timeline and they say where they believe rates will end up. Next year, if you look towards the tail end of 2023, it was supposed to be that 2024 would drop by 1%, 2025 would go down by an additional 1%. That looks to be out the window with the most recent discussions. My bet is not only is it sticky for the next year or two, I believe, and if you look at some of the big names, they agree, like Rick Reeder, the BlackRocks, you look at Bill Ackman, you look at Howard Marks, huge contrarian investors that have been right more times than they've been wrong on big things. The bet is 10 plus years of inflation ahead, because I believe we're missing the biggest drivers of what is actually is actually happening in inflation in the US.
What are those bigger drivers that are driving inflation?
We've seen this interesting thing in the midst of raising rates. We've seen amazingly resilient employment numbers, right? Historically, that's not happened. Historically, during recessions or historically during raising rates, you see unemployment spike. We've seen unemployment barely spike. So that's the root of it, in my opinion, Brian, is that they're one and the same issue. And we want high employment. We want the country to be strong. So why aren't we seeing, so we can celebrate let me say that a different way. We can celebrate the solid employment numbers, but we should see them spike. So why haven't we? The reality is, if you look at the generational differences in the US, you start to see a different story. So if you see the baby boomer generation, the largest generation we've ever had, also the most wealthy, the most wealth condensed there, you see that this generation really coincides almost exactly with the low interest rates that we've had for so many years. So the wealth and the success of the baby boomer generation, if you look at how the US historically has operated as far as which demographics have the most wealth, it was this beautiful sweet spot where the kids went away to college, so your expenses dropped dramatically. And then also around that age, that 50 to 65-year-old range, your income typically starting to hit its stride at its highest peak. Incomes go way up, expenses go way low with the kiddos out of the house. And that's what we saw in the baby boomer generation during that 15-ish year period where we saw rates so remarkably low because they were trying to get investments while they still had a high income. Now, COVID accelerated this, by the way, but now what we're seeing is baby boomers are retiring. They're taking their money with them out of the working force or out of the workforce and out of the investment world. And they're leaning towards the safer, more stabilized, what they would call traditional investments, right? You're looking at stocks and bonds, even though they're yielding less, and well, stocks are doing their thing. And now we're seeing when the baby boomers are leaving the workforce, who's replacing them? Generation Z, right? Which is also the smallest generation we've had in recent US history, and also the least job participation, the lowest participation in the labor force. So now we see inflation from a wage section or from a wage perspective. The large generation is leaving and a smaller generation is replacing them in the workforce, also with different ideas of how things should be paid out and how much they should make. So I think we're going to see labor trends really shake up one big aspect of inflation, along with a lot of things nearshoring or onshoring as far as manufacturing goes in the US, also inflationary. I think we'll see some disruptive trends as far as manufacturing and shipping and imports, exports, also inflationary. And then just that huge capital pull, that huge capital draw away from alternative investments that we're seeing from the baby boomers. So between those factors, and that's just US factors, between those factors, I think there's a huge, huge, huge push up on inflation for the next decade plus.
And you see it going for a decade plus because of just the generational or the demographics that are occurring right now?
Here's an interesting number on the tail end of that. One, I do believe decade plus of inflation. But two, what we're also seeing over the next 2 decades is the largest transfer of wealth that we've ever seen in U.S. history. For the same reason, for the same story, is the baby boomer generation is retiring, but over the next 2 decades, sadly, they're also passing away. So the largest generation and the most wealth, that equates to about $72 trillion that will be reinvested, reintegrated, and redistributed throughout the U.S. economy. So the average person inheriting wealth from a baby boomer is going to inherit around $300,000 on average, right? With the upper end of the spectrum, much more ridiculous, much more dramatic. With that $72 trillion going through the economy, it's overweighted into the millennial generation, which is also the next largest generation after the baby boomers, the children of the baby boomers. So I say decade. There's some big names that say, 2 decades of inflation ahead. My bet is about 10 to 12 years of inflation ahead, because when that investment wave of 72 trillion enters, it's actually one of the best bright spots for real estate's future, in my opinion, because the younger generations have more optimism and more interest in real estate than we've seen in previous generations. So whereas 5 to 10% of a portfolio historically is in alternatives, we could see that triple with a $72 trillion backing.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. On the one hand, inflation drives up interest rates, so investing in real estate becomes more expensive from at least the debt side. But how do you see over the next decade real estate investments faring, and which asset classes would you want to be in?
We try to get as close to the crystal ball as possible. So if we share data, so what? What do you do about it, right? For me, the next decade of real estate investing, I like 3 sectors above all else. The first, I like debt. I've got to say, I like debt with investments backed by rock solid things. So I do like apartments. I do like multifamily. My number one, if I was going to invest on the mortgage side, it would be single family homes, because I think there's 20 years plus of rock solid investment there. 98% of single family homes are fixed rate mortgages. Over 40% of those are, around 40% of those are held by baby boomers, with the around 60% held by non-baby boomers. So there's a long road ahead of that. But so that's one. On the debt side, I like single family. As far as the hard asset side, as far as the commercial side, I mean, there's only 2 winners in my book, Brian. I like industrial because I can really lean into the imports, exports. The drivers of industrial are very clear if you understand the market. And then apartments, right? Multifamily, because multifamily is so ridiculously privileged by the U.S. government. Amazing debt opportunities. We have we have population growth in the U.S. That's great. We have economic growth that looks like a good road ahead. So to me, it's the business sector, right? The industrial side of the equation. And then it's the multifamily side, where people live, and the cities and the surrounding areas and the suburbs. Those are my 2 best bets on commercial by far.
I want to ask you about the U.S. dollar, because that's something that you have a kind of a crystal ball on too. What do you see happen with the U.S. dollar? I mean, right now it's very strong compared to other countries. Is it going to remain strong?
We have a really good analysis tools on our team that break down economic trends. As far as currencies is concerned, I absolutely have tried to find something that could replace the US dollar. And it's not that we're doing so great as far as managing our economy, but it's still so resilient, Brian, right? We're doing so good in spite of the lack of political leadership, and in spite of the difficulties and the gridlocks that we're seeing in Washington, and in spite of all of those things. So one, I think it speaks of resilience of the U.S. population and the amazing people in the U.S. But the other is which currency could possibly replace the U.S. dollar right now? That's the question. It's not Chinese yuan, right? Because at the end of the day, they want such a tight control on it from the CCP that they don't even want it to be widespread enough, because they can't control it the same way. right? If you've seen the currency trends in China, between investment, even their property investment, I believe is like the 99-year lease, right? So the ownership and the controls from the CCP, the Chinese Communist Party, are incredibly not open to a widespread use of their currency. Then you get into discussions of the euro. I mean, just no, right? Europe has enough issues on its horizon with its own demographics and decline there of a lot of things they've got to work through, and the Eurozone stability is even in question. And then you start to get into, other countries that are just not there. Indian currency, or maybe BRICS comes together and, creates a competing currency. But that's the number one, I believe. If there was ever going to be a currency to challenge the US dollar, I believe it would be something from the BRICS zone. But if you look at recent trends with how they treat each other, they don't even want each other to be successful, right? That you look at like Brazil and Russia, how they're treating each other, and which side a lot of these countries are siding with. I do not see a unified currency coming out of BRICS anytime soon whatsoever. So it's really the US dollar is the leader just by stability, just by a stability metric. It's just no one else can trade. I think it's 40 trillion a day in currencies or in transactions on the US dollar. No one can touch that. No one can, take that risk without hyperinflation or hyperdeflation of their own country.
I want to talk about AI now, because that's something else that you have kind of a crystal ball on. What are you seeing as far as AI, artificial intelligence's effect on real estate going forward?
There's questions that underline AI. Does it replace humans? Is always kind of the chief top of mind question. I think AI is going to be the most empowering tools of humans of all time. I truly believe that. I think it's not a human jobs will be lost at net. I think the net will actually be an increase in jobs. So as it relates specifically to real estate and what we're doing at Saint to kind of be ahead of these trends and we're seeing success with, is how can we add AI into the metrics, add AI into analysis, and add it in as a complementary factor. The very tip of the spear on this was REI at Bridgewater. He's been using AI for like 15 years at an ultra high level. And Brian, it has been performing like garbage. That's the problem. Is REI Dalio, multi-billionaire, largest hedge fund in the world at one point, he couldn't crack the code on AI. So the reality is now AI is taking leaps and bounds forward. What took REI Dalio 15 years to still underperform the market, I think the next 15 years will exponentially grow and be exponentially getting ahead. So how do I think it will impact real estate? One, I think there's a shakeout in 2024 across real estate, especially operators. I think it'll be thinner ranks moving forward, and people will be they'll be standing on more deep data analytics of markets is one, and more efficient projections. I think we forget so quickly things like the parallels of how cap rates and interest rates are so intertwined. I think we took that for granted for a decade plus. Now we're relearning that. I think we took for granted things like the stability of bridge debt, that it's not an all-weather debt instrument. And I think that AI building in equations and more look like a Monte Carlo simulation with AI, which is like, hundreds of options at one time with different debt built in. I think you're going to see really, really advanced forward-looking tools that aren't even out today. So I think that's a better road for investors. I think as real estate expands, again, my bet is that 72 trillion will triple the real estate market and triple real estate investment of the average investor's portfolio size. And I think AI is a backbone of that to create a more stable market for decades.
You mentioned REI Dalio and his use of AI. I just finished reading a book called The Fund by Rob Copeland. I don't know if you've heard of it, but basically it debunks the whole REI Dalio AI juggernaut that he's built.
I got to read that.
I think what it highlights is a lot of people say they're leveraging AI to be better at investing or whatever, but very few people have actually figured out how to actually do it. How are you doing it, though? How are you leveraging AI right now in your business?
The highest value of AI in Saint Investment Group is two things. The first is tools to make the investor experience better. So it's things like being able to get to investors. If someone emails us at midnight or chats with us at midnight on our chatbot, et cetera, it's being able to provide them the things more quickly before a human can get back with them. We go for a white glove. Again, our target demo is really high net worth, very successful, typically in an older demographic. So they need more of a white glove walkthrough of things. So we implant AI into things to try and get quicker responses and quicker data and quicker information. That's one. The second is the analytical side. And candidly, I have been trying, when I heard Ray Dalio was doing this, and I got to read that book that you recommended to see how far off my expectations were however many years ago. But as soon as I heard that Ray Dalio was really using AI at a high level, and I really read through it of what he said about his use of AI as a benchmarking tool more than anything, we've been using that quite a bit. And there's a few ways we've been kind of plugging it in. We're still trying to find our number one tool for that. There's some that are really not great, and there's some that might have opportunity that we're still sorting through. But that's really what we're trying to find, is that gem of a tool to benchmark markets with. So, again, we're very focused on industrial on the hard asset side. So we're looking at trends like shipping volumes of ports. We're looking at trends like the volumes of transport of trucking back and forth. We're looking at interstate commerce. We're looking at things like that on our side. If we had an AI tool that could pull all those things together, which is what we're searching for, then that's really what we'd be looking for on that side. Right now, it's a lot of human efforts.
Tell our listeners how they can find out more about you or get a hold of you, and feel free to talk a little bit about Saint Investment.
The best way, the most value that I can offer your listeners is in two areas. The first is we give all our information away for free. We spend a lot of time, effort, and money putting together economics and strategies and different details that they can apply in their own lives. All of that can be found for free at saintinvestment.com/resources. And then if someone's looking for a fixed income opportunity that's real estate backed, that pays between 12 and 14.28% returns, then we have the Saint Income Fund, which for many people right now, that's a really good fit. So that can be found at saintinvestment.com.
What's your favorite hack or app?
I'll give you my most recent one that I'm really obsessed with, is how time is spent. So I have a whole bunch of different ways, even in Saint, is it ops, is it acquisitions, is it marketing, et cetera. So right now I'm using a tool called Toggle that is different categories of time tracking. So I've been tracking time quite a bit to see where my time goes on all that. Other than that, it's simplification. Doing less and focusing more is really kind of my life hack of the last probably 5 years, is being ultra focused.
This has definitely been time well spent. I appreciate you gazing into your crystal ball and talking about the coming inflation decade as you see it, the value of the US dollar, AI's influence going forward on real estate investing, and so much more that we've talked about, Nick. It's been a real pleasure. Thank you for joining us today.
It's been really fun. Great being here, and talk to you again soon.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.